Okay, good morning. Today we will discuss about international financial environment. Coming 40 session will be devoted to international finance. With session 1 we will start with international financial environment. Before that, let me give a outline of the topic. This topic finally principally devoted to international financial environment or international financial management. We also call it international international capital budgeting, international capital structure, international financial environment. In mainly the international aspect of corporate finance devoted to international finance. The topic covered primarily in the area of international financial environment. Session 1 will be devoted to this area. Here we will discuss about how the international financial environment over the year developed, how the trade liberalization, financial sector liberalization has given impetus to international trade and investment. Second session will be devoted to international financial transaction, that is how the international financial corporate sector, primarily the big corporate MNC, how they prepare their balance sheet, where they have exposure to international different countries, where we discuss about the current account, capital account, the current trade deficit and current account deficit. We also discuss about international financial movement, financial flow movement, how it affects the current account and capital account. Over the year, how the international finance MNC move together to different countries and establish their kingdom there. Here we will discuss about the international monetary system, where section 3rd will be there. International monetary system, that is a gold standard, paper currency standard, your over purchasing power parity, the Bretton Woods system we will discuss. We also discuss the floating and fixed exchange rate system, their positive negative about the floating and fixed exchange rate system. We will also discuss the currency basket system. Few countries in the world they have currency basket system, how it affects their current account, capital account, how the stability they achieve over the year. Then section 4 we will discuss about the development of foreign exchange market in India. Indian financial system over the year developed a lot, and since 1991, the liberalization of financial sector primarily in the area of current account, capital account, how it affects the international trade, we will discuss about the same thing. Then we also discuss the foreign exchange market in India. Foreign exchange market, particularly how the over the year we have migrated from the European system to the US dollar system. We also discuss the over the year how the current account and capital account develop in Indian context, the various liberalization measure, particularly in the area of FI investment, FDI investment, how it affect our current account deficit, capital account deficit, our trade liberalization system, how in India as a part to the WTO agreement, we will also discuss about that. And then most important section is the section 8, which cover the exchange rate arithmetic, how the foreign exchange market develop over the year, who are the participants in the international foreign exchange market. We will discuss about the exchange rate arithmetic, and we also discuss how exchange rate are quote with the direct method, indirect method, and we also take into account that transfer of foreign funds and bills payment, trade deficit in the exchange rates quotation side. In the international parity condition, one of the important theories, many important theories are there in the international parity condition. In section 15th will be devoted in this area. Here we will discuss international Fisher effect, international parity theory, covered interest theory, and also we will discuss international purchasing power, international uncovered parity, and real interest parity, how inflation affect in the movement of foreign currency, how international parity condition decides the short term interest rate in the world economy. We will discuss in section 15 entire international parity theory. Section 17 and 18 also devoted to international parity condition. Here we will discuss the real effective exchange rate, the nominal effective exchange rate, how the central bank, in case of India it is RBI, they target the real effective and nominal effective exchange rate for the trade liberalization. And in section 21, we will discuss about the exchange rate exposure. As you know, many MNC have established their establishment, particularly company in different part of the world. Among them trade inflow, your foreign currency inflow outflow take place. How they manage the foreign currency balance sheet, and how the risks, the movement of foreign currency created risks, and how the MNC absorb the risks and also take a position in the financial market. We will discuss about that. In the foreign exchange exposure side, we will discuss the transaction exposure, translation exposure, and also the economic exposure. And section not only will discuss about the exposure, also how the MNC manage their exposure over the year, different theories, different way of calculation of exposure, and management of exposure we will discuss in section 20, 22, 23, 24 and 25. In 26 and 27 we will discuss about the movement of trade finance, how the MNC get the trade finance. Here we will discuss about equity finance, international equity finance, the JDR, ADR. We will also discuss about the international cross listing of shares, the equity of MNC listed in different stock exchange of the world. We will discuss about the international equity market and cross listing of share. We also discuss about international bond market. Many MNC are raising the funds from the abroad market, because abroad market are cheaper in terms of interest rate, and many MNC, particularly developing country MNC, are raising funds from the international bond market. We will discuss about the convertibility bond, floating zero coupon bond. We will also discuss about floating rate LIBOR, floating rate, your how international rating affect the bond inflow and bond outflow. The rating also sovereign rating, your international MNC rating also affected the bond market. We will also discuss about the same thing. Then in our section 36, we will discuss about international capital structure, because MNC are spread their wings all over the world. It is not the domestic bond market or domestic equity market important for them. International equity market, international bond market very important for them. Here the capital structure, which is earlier domestic in nature, become international aspect, because in their balance sheet they have many foreign currency assets and liability which affect their capital structure. We will discuss about the international capital structure, and also how the domestic capital structure CAPM model is irrelevant when the MNC have international borrowings and lending, right. In other aspect, like in the international capital budgeting is very important. Earlier the international capital budgeting was not so important as compared to the domestic capital budgeting, because MNC where domestic companies were primarily raising their funds from the domestic market. However, over the year when they raise their funds from the different parts of the world, it is not the domestic capital budgeting is irrelevant. We will discuss about foreign direct investment, how foreign direct investment you can evaluate in the context of a capital budgeting. These 40 sessions are devoted to international international financial management, and we try to cover all the 40 sessions in different plan way. I have designed today we will discuss section 1, which primarily in the area of international financial environment. You know, over the year the globalization may be a new term in early 19th and 20th century. However, the globalization over the year has affected the movement of capital, movement of human being, and established what is called international capital environment. We will discuss about globalization, which we consider as a new phenomenon. It is not new. The human civilization human civilization started with a globalization environment. If you see the largest migration was the migration of human being in early 17th and 18th century. Hence, the globalization is not a new phenomenon at present. Through the instrument of colonial expansion, the Britishers established the global capitalism all over the world, and Western European country with their massive funds, technology, they established their kingdom all over the world. This leads to what is called movement of capital, movement of human being, and movement of technology all over the world. The globalization, if you see at present, is not so much as compared to 19th and 20th century, because over the year after the Second World War, many country what is called, they established what is called the trade barrier in the movements of goods and services. This affect the movements of capital over the world, and this leads to what is called a trade regime. We had different trade regime in early part of the 20th century, but trade regime over the year reduces because of the establishment of the international financial institution and international financial organization. Particularly if you see the after the Second World War, the Great Depression affected the monetary system and world political system. The economists came to know that we have to remove this trade barrier for the stability of the world economy, and this led to establishment of the world level financial institution, what is called IMF and other institutions like that, General Agreement on Tariff and Trade, World Trade Finance, and this organization help in establishing the world financial system. And after the Second World War, many countries demolished or abolished their what is called the gold standard or the metallic standard, and they established the paper currency standard. Paper currency standard lead to some kind of purchasing power parity, and this purchasing power parity depends upon the individual country inflation and the wage payment, taxation, political system, and this purchasing power parity lead very difficult to create a currency environment where each and every currency can be exchanged to each other, and this problem taken care of by the IMF, which established the convertibility of purchasing power parity, and this help in creating a world foreign exchange market. Different foreign currency of the world, foreign currency which came through either the trade or through the international financial flow exchange among themselves through in the international foreign currency market. And it is the IMF and the all other international financial organization, they establish the international foreign currency market, and this help in the smooth flow of international trade and international capital flow. The decade of 80s, this process continued till 1980s. Decade of 80 witnessed more liberalization in the world financial system. They witnessed in this decade of 80 also known as the open economy macroeconomic policy of developing country. Developing country, they came to know that they cannot function in a environment of trade in an environment of closed economy. They open their economy, they liberalize their interest rate, exchange rate, and try to integrate the world financial system, and this lead to the liberalization of Latin American country. Many Asian country also adopt the liberalized financial system, and this help in establishing a more global economy. Similarly, we can see that several Latin American country, Asian country implemented the financial reform policy or eliminated the government control of domestic interest rate, exchange rate, and credit allocation. This helped in establishing the world financial system. The decade of 90s is generally considered as the reunification of global economy. the world reached a climax in the process of integration of developed and developing world. The disintegration of Soviet Union also helped in establishing a larger world kingdom. The emergence of market oriented economy in Asia, the creation of single European market, the formation of a new era of trade liberalization through World Trade Organization, and development of IT based communication system and services have significantly contribute in the further expansion of the global financial system. But however, the world economy at present is not as smooth as it was earlier. The movement of the large capital inflow with the large capital inflow the movement of large capital inflow also created more risks in the world financial system. The more risks in the form of risk capital, we generally call hedge fund of different companies, move one country to another country and create international upheavals in the financial environment. The movement of capital also leads to the risk flow, which affected the flow of what is called riskless capital or the bonds, international bond market. Many foreign institutional investors, they move their funds from one country to another country for the sake of getting more profit. They use this FI investment in stock market and create more upheavals or volatility in the domestic capital market. This affected and created more risks in the international financial environment. This is a problematic aspect of world economy, and so this has led to the what is called a subprime crisis, which now 2006 onwards we have been witnessing all over the world. The subprime crisis has led to recession in the world economy and weakening the balance sheet of the many financial institutions. The global financial system has proved to be inadequate in the form of absorbing this kind of risk or creating a regulatory framework to minimize the risks of capital inflow. There is a need for establishing a world level financial institution, more regulatory power, so that they can manage or they can monitor the risk movement of risk capital all over the world. This has called for establishing what is called a global monitoring authority, because for the smooth flow of international finance we need a regulatory framework. The regulatory framework should be in a position that it can keep a vigil in the movement of risk capital all over the world. For this reason, we requires at present a smooth functioning of the world financial system. This has called for reducing the stress in the form of the movement of risk capital, and this has called for reinventing the international financial institution. We have to give more power to international financial institutions, particularly the IMF, other world body, so that they can put a vigil in the movement of the risk capital. In this section, we primarily focus on the establishment of the what is called a international financial environment. This international financial environment requires that for the smooth functioning of the world financial institution, many countries have liberalized their trade barrier, established a integrating path for the integrating path to link to the world economy. And world economy at present, though it is at a recession phase, however, world definitely over the coming 2-3 years the world economy will revive its trend, and we need the further establishment of a world level organization which can prevent this kind of subprime crisis. And world financial system, particularly the movement of the short term capital which generally invest in stock market, in the foreign exchange market need to be controlled, and for the smooth flow of international trade. International trade, we have to differentiate between the international trade and international financial flow. International trade needs there should be a proper banking system, there should be proper payment system. However, for the smooth transaction of export, import and invisible. At the same time, international financial flow needs the linkages of different banking institution, financial institution, so that there should be financial flow from one country to another country. Financial flow primarily move from to take the arbitrage opportunity. Generally, developing country and developed country, the interest rate differential and leads to the flow of funds from developed country to developing country. However, this flow is short term in nature and create more risks in the international financial environment. International financial environment needs the stability of the capital flow, stability of the funds flow, and in this context we have to give more importance to the trade finance rather than the finance movement to the risk capital. But risk capital generally affects the financial institution balance sheet, because once the economy in a downturn or economy some kind of volatilities are there, the risk capital never stay in the country. They migrate from one country to another country to take into account the arbitrage opportunity. Arbitrage opportunities are there because there is a differential in interest rate, differential in the return in the stock market. This arbitrage opportunity lead to the movement of hot money. We call the short term movement of foreign currency as hot money movement. The hot money movement create volatility in the stock market, volatility in the domestic environment, and also affect the smooth flow of the World Trade Organization or the smooth flow of the international trade. International trade and the trade and international financial movement need to be differentiated, and that should be some kind of regulatory environment to keep vigil on the movement of the trade international short term capital for the smooth establishment of world trade finance. On this background, we need to outline what are the characteristic of a international financial environment. The basic characteristic of the world international financial environment that depends upon the movements of capital flow or short term capital, and this lead to the exchange of different currency. Foreign exchange market which generally consider the exchange of one currency to another currency or exchange of many currency among each other is a largest market in the world, and trillions of transactions take place in a few seconds. This largest market need to be tapped need to be monitored in such a way that there should not be any high volatility in such market. The market have a own potential and market has own volume. The volumes are so much that you can, when in a few seconds it may create havoc in the finance in any country domestic market. So, when the country try to integrate with the world financial system, they should be aware of the volumes and movement of this foreign currency, and on this basis they should liberalize their capital account and current account, because the international balance sheet of a country is primarily composed of the capital account and current account. The current account take into account the export, import, trade, and capital account take into account the movement of foreign capital which are long term in nature. So, in foreign capital account we have FI investment, we have export import, we have a trade, we have interest payment, we have other short term payments and receivables, payables and receivables which are very volatile in nature, and this may lead to what is called movement of funds from one country to another in a few seconds. On the other hand, capital account take into account primarily the large borrowings, FDI, foreign direct investment, and also the government government and the government and the country's MNC which they generally borrow from the abroad market, they take into account in the capital side. A capital account is more stable in nature, however, current account is more volatile in nature. But current account primarily composed of export import, which are generally called a trade finance or mercantile trade. And in a developing country like India, the export and import, the trade deficit is quite high. So, because our imports are more than our export, and in this context we have to liberalize the capital account to allow more capital inflow to the country. But in the current account we have more invisible in the form of the receivable from abroad, which is generally called income inflow. Our peoples are working abroad, they send their fund to domestic country, and this we call NRI deposits, NRI receivables, which are a part of the current account and which generally breach our deficit in the current account. However, our trades are more in nature of inelastic, because our imports are inelastic in nature, which primarily in the form of oil imports, primarily in the form of technology imports, primarily in the form of some kind of raw material import or some kind of capital goods inflow, which generally we use it for the export side. Our import side, primarily the oil import are inelastic in nature, because it is essential commodity. On the other hand, our exports are non-traditional in nature, which may not be in a position to take advantage of the movement of foreign currency, and trade regime need to be further liberalized and give boost to our value added trade, which take into account the export side. Value added trade may allow us to earn more foreign exchange, and this will breach our trade deficit. At that same time, we should take into account more liberalization on current account by allowing more inflow of dollars or foreign currency to the India. On the other hand, capital account take into account primarily that foreign currency borrowing, FDI, that we have to liberalize the capital account in such a way it should not affect the international capital movement. However, on the other hand, it should give more important to our international balance sheet, which is more current account deficit. Current account deficit create more volatility in the financial market, and the volatility can be arrested or can be reduced by allowing the more liberalization in current and capital account. This session primarily devoted to international environment. International environment, as I told you, the foreign exchange market primarily, but on the other hand, international environment also have what is called the domestic environment. Domestic environment is more in our financial institution, our financial market, because there is an integration of domestic financial market and international financial market. We have to liberalize our interest rate, we have to liberalize give more importance to our domestic financial institution. They should practice that they should practice the banking and financial sector in a more liberalized environment, because the freedom required for them to take decision rather than the compulsion. The freedom in the form of interest rate liberalization, freedom in the form of liberalization of capital movement, freedom in the form of allowing the domestic MNC, domestic financial institution to borrow from abroad market, because this allow them to bring technology, this allow them to bring capital to the domestic environment. Only the capital and technology can give boost to our export side, which is actually essential for the bridging that trade deficit. Our interest rate scenario, if you see our interest rate scenario at present more liberalized in nature, the interest rate help in bridging that bridging the gap between domestic interested environment and abroad interested environment, because this is essential. This is essential for integrating the domestic economy to the world economy. However, the integration leads to what is called more problem in nature. Problematic aspect is in the form of the international instability or the global level instability may come to the domestic environment. You have to take sufficient protection in the form of more not allowing the capital account in a drastic liberalization, because the international financial environment at present is highly unstable. The instability may come to the domestic environment, domestic market, and it create more problem to domestic financial institution. So, international liberalization essential for the success of the domestic financial market, domestic economy. At the same time, it should create sufficient protectionist measure, so that the international political and international instability should not come to the domestic environment. There are many such kind of what is called problematic aspect of the world economy. The capital flow, as I mentioned earlier, is linked to risks or hot money movement. This may affect our domestic financial environment. Similarly, at present the economy is in a subprime crisis, world economy recession. The recession or the world economy downturn has also affected us. We have to take care of our domestic economy by boosting the our domestic requirement in the form of our allowing our domestic financial organization, a domestic company to get fund from the domestic financial market. Similarly, our financial market and many other domestic financial companies, the balance sheet is very stressed in nature, because earlier they were part of the international financial market, and international financial market at present in a stressed environment. We have to protect this domestic company by giving some kind of reformatic measure in the form of low cost fund, in the form of reducing the tariff barrier, in the form of reducing the taxation side. At the same time, your present day international regulatory system is not sufficient to protect the domestic economy. So, in this process we have to negotiate with the world financial organization, other country, and establish a world level monitoring organization. The monitoring organization should have sufficient power to protect the individual economy, to protect the individual economy in the form of movement of hard money, movement of short term capital, movement of risk capital, and this risk capital, as I mentioned earlier, also create more instability in the domestic sector. So, the world economy need to be reconstituted in the form of a new financial architecture. The new financial architecture should take into account the movement of foreign currency, movement of short term capital, movement of hard money, and also create such kind of regulatory framework which can protect the domestic economy. The world international financial architecture should also take into account the integrating the world economy in a smooth manner, so that the world trade finance or world level export import should not be affected. At the same time, the international financial architecture should take into account the WTO and WTO side. The WTO or the World Trade Organization should be given sufficient power to create a smooth international trade. In this context, the requirement of the developing country should also be protected. Domestic World Trade Organization over the year has liberalized the world trade significantly. The tariff which affected the movement of the goods and services also have been reduced over the year. The World Trade Organization has been considering over the year the movement of labor forces, the movement of agriculture goods, movement of services, movement of technology, movement of intellectual capitals, and this need further negotiation, because these are the very sensitive issue in international financial environment. The agriculture side, movement of labor, movement of short term capital, movement of intellectual property, these are the very sensitive issue in sensitive issue to world trade, and this need further negotiation. A negotiation should take into account the requirement of developing country, because developing country at present in the transition phase. The transition, they need more capital, they need more new technology, they need protectionist environment, and for them the World Trade Organization should also consider how to develop this developing country. In this context, the environment issue, the issue of intellectual property, the issue of world level technology is very sensitive in nature, and this sensitivity should be discussed in World Trade Organization, and try to give more importance to developing country, where developing sizable section of the society, sizable section of the population are poorer in nature. Developed country over the year that they establish their economy, they establish their market, and they need less protection as compared to developing country. So, in this context, we come to such the environment side, where international capital structure, international property, international financial movement, and international foreign currency market need to be discussed in a more detailed manner. And for this, we have designed the international financial and financial topic in such a way that this issue need to be addressed more detailed manner, because the movement of foreign currency affect the world trade and finance, and this foreign currency are very short term in nature. They move from one market to another market, one economy to another economy in a very few seconds, and this foreign currency movement create more risks in the domestic financial market, and domestic MNC and domestic economy affected because of this movement of foreign currency. Over nowadays, if you see there is hardly any difference between domestic company and the MNC, because many such companies are sourcing their export import from the world financial market, and when the movement of foreign currency affects their balance sheet. It generally mentions that if you have exposure, if a company has exposure in foreign currency, either in the form of payment of interest, in the form of export, in the form of import, or any other format which is linked to foreign currency, their balance sheet is never closed, because their balance sheet anywhere in the world, the foreign currency market is open. It is a 24 hours market. The market start from the Tokyo early morning and end at Tokyo again at the early morning, and in this process even though the world financial systems are closed, the international financial environment, which is primarily foreign currency oriented, never closed. It is a 24-hour market. In our balance sheet of MNC company are open, because the movement of foreign currency lead to the change of exchange rate which have changed its value every second, affect the asset liability of the foreign MNC. The asset liability continuously changing with the movement of foreign currency. Hence, the foreign currency exposure of MNC is foreign currency exposure of MNC is need to be studied in a detailed manner. At the same time, we also take into account how the MNCs are borrowing from the world financial system. In this context, we have to study the entire international financial market. International financial market are short term in nature, which fulfill the requirement of working capital borrowing. At the same time, international financial market also long term in nature, which fulfill the requirement of capital borrowing, long term borrowing, technology finance, also finance of long term project. So, you have to study in detail the international trade trade finance in a significant way. Also, there are movement of foreign currency from one country to another. How the payment system take care the movement of foreign currency. In this context, we have to study the international payment system. How the different bodies are there, different organizations are there. They take into account the international payment system. In this context, we should study the Eurozone. We also study the US zone, and also at the same time we have to study the Asian currency union. The currency union, how the international settlement take place in this market. At the same time, we have to study the international equity market. International equity market, because many MNCs are borrowing from abroad in the form of diluting their equity. In Indian context, we have JDR, ADR, many companies like Infosys, TCS, many other manufacturing companies. They have raised their money from abroad by diluting their equity. In this context, we should study the JDR, ADR, the global depository receipt, and also American depository receipt. We have also Indian depository receipt. We will study in detail this depository receipt side also. International capital structure, as I mentioned in my lecture, that many such country have MNC have borrowed from different financial market, and their balance sheet composed of not only the domestic capital, but also that international capital. When international exposures are there in the capital structure, the domestic capital structure is not valid. In this context, we should study what is called the market segmentation and market integration. When the world markets are segmented, there is arbitrage opportunity available. World markets are integrated, the arbitrage opportunity will not be available. Arbitrage opportunity provide some kind of windows in the form of what is called differential interest rate, and which will lead to reduction of the cost of capital. But as the world economy is moving towards more integrated manner, the arbitrage opportunity over the year reducing, and in this context we will see how the capital structure is affected because of market segmentation and market integration. And as you know, the foreign direct investment, many developing countries, and they are inviting the MNC to invest in their domestic market. In this context, the foreign direct investments are coming from different countries. We have to understand how the foreign MNC are evaluating the foreign direct investment before they try to invest in a domestic economy. So, in this context, we will study that how the domestic financial environment allow the foreign direct investment, what are the political risks are there, sovereign risks are there, how the financial market allowing that foreign direct investment, what are the liberalization measures of domestic economies have done. In this context, you try to study the domestic financial environment for the MNC in the Indian context. The liberalization measure 1991 onwards, what we have achieved, we have done how the liberalization measure allow the domestic foreign company to invest in Indian context, and how the foreign company take into account the project finance, project side, and try to project side and evaluate the project in the light of foreign currency movement. So, international financial environment, before coming to end, I have to mention here that it is very difficult to analyze the international financial environment, primarily because it is a very dynamic world where foreign currency movement take place. In a dynamic world, when policy changes are taking place every moment, this international financial environment is evolving in nature. No country in the world has established full convertibility. No country in the world have stopped the movement of foreign currency. So, in a international environment at present is evolving in nature. So, we have to continuously monitor the international environment to protect the domestic economy. So, in this context, we have to see how the Indian financial sector, in particular the foreign exchange market, developed since 1965-67 onwards, and still now which is the phase we are passing through, and we will analyze the domestic globalization and try to find how it affects the movement of foreign currency in India, the liberalization of capital, liberalization of FI investment, liberalization of financial sector, interest rate liberalization, exchange rate liberalization, how it affects the movement of foreign currency, how it affects the international financial environment, and we try to study the different aspects of the financial environment in a subsequent section. Before coming to end, let me give you the references here. There primarily I follow the references of the World Trade Organization. If you see the website of the World Trade Organization, the World Trade earlier it was known as GATT, General Agreement of Trade and Tariff. In 92-93 onwards, they have changed their name to World Trade Organization. The World Trade Organization is the organization of the world level, where member countries agreed to liberalize the international trade, and here the liberalization of tariffs, liberalization of custom duties, negotiation among different countries to liberalize the international trades are mentioned there. You can go through the World Trade Organization website, try to find the liberalization in the world economy, particularly the trade regime. I also follow the Brookings Institution, where the J.D. Sachs and Asland Fisher, they written one paper on paper, particularly in the anniversary paper issues in 1995. They survey the economic reform and the process of global integration. Here also I found that this paper is very useful to understand the economic liberalization over the years. They have not confined the liberalization in particular country. They have mentioned there over the years how the world economy has liberalized and how the world economy has become more integrated at present. And the third one I mentioned here that primarily in the Indian context 1947 to 2007, the foreign trade of India. Here the foreign trades policy prospect, a Viva Mathur New Century publication, they mentioned that, and here they analyze the trade regime, Indian foreign trade, the liberalization aspect, direction of trade, custom duty, tariff liberalization, liberalization of FDI investment, the all trends and policy they mentioned that. This book also good to understand the trade regime in Indian context. Here I am supposed to mention here that the trade has two parts in Indian context. One part is called that items or the goods and services, another part is a direction. Items are not only generally we classify items, trade items in the form of manufactured goods, in the form of traditional and non-traditional good. Traditional good in the form of handicraft export, in the form of exports of raw materials, in the form of exports of mineral commodities, and also we have all these commodities we have been exporting because we are not in a position to give value addition to this commodity. This commodity though have a market, but we could not get sufficient amount of foreign exchange. We need to improve our value added export, which to capture the world market. If you see world trade, our export is hardly less than 1% of the world export. So, we have to export more by giving more importance to the manufacturing side and more important to what is called the value added trade. On the other hand, we have a direction of export. What is the direction? Which country you are exporting? Direction, we have a US dollar, US country, our Latin American country, we have a country to like our Saudi Arabian country, we have a country other Asian country, European Union, but our export primarily directed to US economy and European country. Our we have not so far directed our export to South Africa side, African country side, who are more important to export. And direction of export is very important because we should not confine to one country, one zone, because it may affect that one country export, that their import may affect our export side. So, we have to diffuse our export to different part of the country, to take into a different part of the world, to take into account the advantage of this country. Okay, before coming to end, let me go for the model questions here. The model question I have mentioned here: write in brief the historical development of international financial environment. Here, and second question is briefly outline the transition of Indian foreign trade after 1991 economic reform, and third question is outline the missing link of globalization. In the first question number 1, write in brief the historical development of international financial environment. Here you have to mention how the international trade environment developed over the year. Before mentioning that, you have to outline the 17th-18th century, the movements of human being, establishment of different countries, establishment of sovereign powers. You have to establish here, you have to mention here the colonial expansion of the European country, primarily the Great Britain, how they expand their economy to different part of the world, particularly the Asian country and also African country. Here also you mention after the first and second world war, how the world economy developed, how the establishment of World Trade Organization, particularly the GATT, WTO, IMF has helped in creating an environment for the smooth international financial movement, also international movements of goods and services. In that question also we mention that how the developing country and the Soviet Union have integrated a world economic system, how the capitalism spread all over the world, and how the MNC have spread their wings, spread their company different part of the world. This will lead to this may help you analyzing the historical development of the international financial environment. Second question is you briefly outline the transition of Indian foreign trade after the 1991 economic reform. Here you have to mention how the Indian economy has liberalized their financial sector, the world trade sector and the other economic policy, particularly the licensing Raj, the MRTP Act abolished. We have established the competition commission, we have liberalized their allow the our domestic company to move from one country to another country. We have also liberalized their foreign currency market. We have liberalized the export import side. We have established a foreign currency market. We also mentioned that the current account convertibility, capital account debilitation side, how it help in the foreign currency foreign trade in the Indian context. Here also I mentioned how the India has become a member of the WTO and the member country Indian export import duty, particularly custom duty have reduced for different goods and services. Once upon a time the custom duty was more than 100-200%, it has been reduced to 35-40% now. This help in further this help in boosting our trade. Here also we mention how are our direction and items of trade. Our direction of trade earlier the US, European country, US, and also we have established our trade link to African countries. Here also we mention our different items of trade. We have now more value-added trade, the mineral export, the export of traditional goods. Traditional good has reduced over the year, however value-added export has increased. We established a new source of export, particularly the soft export. We call it the software technology exports. That is also a major part of our export basket now. And this way you can analyze the Indian foreign currency foreign trade after the 1991 economic reform. Third question is outline the missing link of globalization. Here we have discussed in our presentation that There are many missing links are there in globalization process. First missing link is the human face of liberalization. The liberalization has help in the society or not, you have to understand that. And also you mean the liberalization lead to more movement of risk capital. It has created financial sector upheavals, it has created world subprime crisis, it has created the risks in more risks in the world economy. We have to establish these links. The missing links are that we have to establish a global level financial institution to monitor the movement of risk capital. This is essential for you for the success of the world economy, because world economy needs smooth flow of capital. At the same time, world economy also need to manage the risks. Risks is there, this will affect the world trade, and also risks is there, it affects the movement of world capital. For this reason, the management of risks and the liberalization should go together, and we have to establish such kind of institution, world level institution which can monitor the risks, and with a regulatory framework they can establish the smooth flow of international trade and finance. Thank you.